Financial Accounting, Corporations and Stockholders' Equity. Today we are going to review the characteristics of a corporation. Corporations are not the most prevalent form of business in the United States. It's actually sole proprietorships. There's 80% of all businesses are sole proprietorships. About 15% are corporations. However, of those 15%, they generate 80% of all the revenues in the United States. The corporation has a separate legal existence. You would apply to your local state and complete the paperwork and pay associated fees to become a corporation and be chartered by the state. That will allow you to issue stock to shareholders, and that is one of the big benefits of a corporation. By issuing stock, it's a good way to raise funds, to help fund the business, to help grow the business. The other, with stocks, it eases in the transfer of ownership. If you were a sole proprietorship and the sole proprietor dies, frequently that business will cease. A corporation, if one of the shareholders dies, well, the stock can be left to another family member, it can be sold to other investors, and the corporation continues to flow indefinitely. The corporation has a continuous life. Again, a sole proprietorship is governed by the life of the owner. A corporation can continue indefinitely. The major advantage of a corporate business structure is this thing called limited liability. Limited liability means that the investors or the owners of the company, their liability is only limited to the amount that they have invested in it. If the company would not pay its bills, they can't go after the shareholders personally and make them responsible. If it was a sole proprietorship or even a partnership, that may not be the case. And so the limited liability feature is a big factor in why many small businesses may start off as a sole proprietorship and may eventually become a corporation. The earnings of a corporation are distributed to the shareholders through dividends. The board of directors determines the amount of dividends. They declare what those dividends will be, and they are paid out to the shareholders proportionally based on the number of shares that they have. Some disadvantages of a corporation is that the initial startup costs are higher than other forms of business. The ownership and management are frequently separated. Shareholders may not have any involvement at all in the day-to-day management of the business. And while that we mentioned that was a way that ownership could be transferred easily by these shares of stock, there also is a separation between the ownership and management. The government will also have ongoing requirements for a corporation that once you're established as a corporation that you have to maintain and keep detailed records of and submit reports and have individual tax returns, corporate tax returns that have to be completed as well. So there's an ongoing regulatory requirement to corporations as well. And the other disadvantage is called double taxation. When a corporation earns money, those monies are taxed. When the dividends are paid to the shareholders, the individual shareholders also are taxed on the amount of those dividends. So in essence, that income has been taxed 2 times. And that is the other disadvantage of having a corporate form of business.